Well, I think what you're looking at is incoming restrictions on supply. That's going to couple with what we've been seeing in Venezuela that's likely forcing the oil price up that we've seen this morning. Now, again, it's about how sustainable that oil price is. You look out into the futures market, go 3 years out. You typically go out that far when you want to take out political risk and look at how much geopolitical risk premiums priced into oil. Right now, it's some of the highest levels since the Arab Spring. That's not exactly a great backdrop for energy companies to really be able to continue to put that oil number in a reliable way going forward. So certainly some question marks over it.
How do you think it's going to play in your model?
So, we actually think higher oil prices are good for our S&P 500 EPS estimate. It tends to be good for energy company earnings. Of course, there are puts and takes with margin pressures, but generally we think higher oil prices are good for the earnings outlook generally. I would say, energy was this sector. It looks super cheap to us. You're in the middle of an earnings revision rebound in that space. 2020 earnings expectations actually look pretty good. I think as long as that can hold up, I actually think this can help generate excitement in the space.
All right. Obviously, we're at the early inning of earnings season,
yeah.
But is it shaping up well? I mean, percentage of companies beating is trending down a bit. I just wonder whether or not you think it's going to end up being a quarter we can brag about in any way.
Well, I do think we thought the bar was set pretty low coming into this reporting season. I mean, our model's consistently been spitting out 171 on the S&P EPS number. Consensus came into this around 167. What struck me among the very early reporters was that their earning beats were pretty strong, but the sales beats were pretty weak. And I think it's tough to gauge the trend right now. We've heard from a lot of financials, a few industrials. I'm really eager to hear from the tech and consumer companies.
I mean, look, the calendar this week is going to be fun, Alex.
Yeah.
30% of the S&P, 40% of the Dow reports. Coming into the year, there was this notion of an earnings recession, 2 down quarters of earnings.
Yep.
Is that going to happen?
I don't think so. The focus, though, for me is on the margins. I think that's where the pressure has been coming from. Through 2016, 17, 18, you could rely on some fat margins to give yourself some cushion on the earnings side. Now those companies in their fourth quarter earnings reports were saying, look, wages are picking up. We're also seeing increased cost of servicing debt. The two biggest outputs for a company were starting to rise. Now that we're starting to see the year-on-year impact of the tax bill begin to fade, I want to see what the actual undistorted margins numbers are going to look like and what those wage pressures are going to be doing. And the forward guidance is going to be key. I think earnings analyst estimates for this quarter, we think are too negative. We think there's going to be some beats, but this week is going to be a key week for that.